G'day. This is Investing, and I'm Vince Scully, founder of Life Sherpa Invest, where we build evidence-based portfolios for Australians from $5,000. Today, we're going to look at the options for investing to generate the returns you need at the risk you can tolerate. And I call the building blocks of a portfolio the 5 Bs. And so whether you're a seasoned investor or just getting started on your investment journey, this is for you. All right, so to think about investing, we generally look at investments in 2 categories. We talk about defensive assets and growth assets. Now, we finance guys aren't particularly imaginative when it comes to naming stuff, so it's sort of what it says on the tin, that growth assets is the engine of returns in your portfolio, and defensive assets is about smoothing out the bumps that allows you to sleep at night. And there are 5 Bs that fall into those 2 categories. So starting off with defensive, the first B is bills, as in bank bills, cash, and you want to hold some of that for liquidity so you can take advantage of market dips. You also need some liquidity to pay for expenses and brokerage and make sure that you never have a failed trade. The second B is bonds, and bonds are often called fixed interest. And they are broadly loans to governments and companies, generally high credit rating companies, where you earn interest. It's called fixed interest because typically it was a fixed rate of interest on the face value of the bond, and then you get your capital back at the end of the period. It is important to understand the drivers of returns in bonds. There are 2 key factors. There's credit rating, that is the likelihood that the issuer is going to give you back your money and pay your interest on time, and duration, that is how long the bond is for. So governments issue bonds up to 100 years, 150 years. In fact, I think the UK government has actually issued a 999-year bond. The longer the bond, the more risk there is, and therefore the greater the return you should earn. And credit rating, obviously, the riskier the issuer, the more you should be getting paid. So in Australia, federal government bonds are the safest it can be. Now, that doesn't mean that the value is not going to change. The value of a bond that pays a fixed rate of interest will move up and down as the market interest rate changes. So if you bought a 10-year 3% government bond and interest rates in the markets jump up to 4%, well, your $100 bond ain't worth $100 anymore. You'll still get $100 back at the end of year 10, but that's how we get returns on bonds. And the interesting thing about bonds is there are thousands and thousands, tens of thousands of issuers and issuances. And so the index, which we'll come back in another episode and discover what an index actually is. But in this context, even an indexed bond fund like IAF, the BlackRock Australian High Credit Bond Fund, holds 706 items from 193 issuers, but there's thousands in the index. So even an index fund is an active fund, and we'll understand come back and look at what that means in a future episode. The third B is bullion, which is a word that begins with B that is designed to mean commodities, but for most practical purposes, for individual investors, that means gold. And that's on a bit of a trend at the moment. We've seen queues in Martin Place of people outside the bullion shop, but there are reasons why we keep it in the portfolio, not just because it's hitting all-time highs. So the gold price hit $4,379 a US an ounce, or $6,311 Australian dollars during October of 2025, just before we go to air. And these are all-time highs. That's not a reason to buy it or not to buy it. The reason we hold it in portfolios, and Life Sherpa, we've been holding gold in our portfolios for over a decade, we do that because it behaves differently. Statistically, we call this a correlation, so that a gold is negatively correlated, that it moves in a different direction to share prices. Technically, it's got a negative 0.26 correlation, which means if shares go up by $1, it should go down by 26 cents and vice versa. And that forms a really important part of building a portfolio. And we'll look at building a portfolio in another episode. But this is really important for Australian investors in particular, because there's a double whammy here. So if you've been on the internet consuming finance content, which is mostly created in the US, you'll get a different answer. But looked at from the perspective of an Australian investor, we get to double dip in gold. And the reason that works is that when markets get choppy, so when the world hits recession, when prices start falling, when investors start moving away from risk, they flock to the US dollar. And this is particularly important for Australian investors. So if you've been consuming internet content, much of which is created in the US, you'll get a different view of the world. So you need to look at this as somebody who lives in a commodity currency. So that's we Australians, South Africans and Canadians in particular. And the reason that's important is that when the going gets tough in markets, investors flock to the US dollar as a safe haven. And that means the US dollar rises relative to other currencies, particularly the Australian dollar. And that means holding assets that are denominated in US dollars, like US shares, the value of those goes up when your Australian shares are going to fall. And gold is denominated in US dollars, and it's also attractive to investors when the going gets tough. So gold price goes up, US dollar goes up, double whammy for Australian investors. So all of that has the effect of lowering the volatility in your portfolio. And we'll come back in a future episode to what volatility means and why it's important. And so using gold allows you to achieve a fair bit of smoothing without giving up much by way of returns. And I've got a graph here which shows how that played out in the GFC. So if we look at 2007 to 2010, for those playing along at home, the share market peaked towards the end of November 2007 and then slid slowly, sometimes sharply, for the best part of 2 years and bottomed in 2009. But over that period, gold moved in the opposite direction. So by the time you get to 2009, gold is up 60% and shares are down. In shares in this context being the ASX 200 is down 40%. So that difference helps smooth out the movements in your portfolio. And that also played out in COVID. So for those of you probably with more vivid memories of COVID, and of course we were far more concerned about staying alive than what was happening in our portfolios, that we had that really steep decline in equities or shares or stocks around the world from late February to early April, where the market was down over 30%. So in this case, the ASX 200, again, down just over 30%. Gold was up 10% in that period. But over the year, so by the time you get into early 2021, they've both come back together again. So that's another good example of how this can smooth out the returns in your portfolio. And in this case, you wouldn't have given up any return to get that lower volatility. And we'll see this when we come back and look at building a portfolio in a future episode, that it's all about return per unit risk. So that's B for bullion, B for gold. And that, in our case at Life Sherpa, is the first port of call in defensive. So if you've got a very high growth portfolio, then the first slice of defensive assets would be gold. So that takes us through the three defensive Bs. That's bills, cash, bonds, loans to governments, bullion, gold. And that will then bring us on to look at the growth Bs. But first, let's take a break and I'll be right back.
This is Investing is brought to you by Life Sherpa Invest. If you want your money to work harder and not just sit in a savings account earning crumbs, check out Life Sherpa Invest. Choose from 4 risk-based portfolios like Everest 90 with 90% in growth assets. Long-term, low-cost and built for people who are after serious returns. Invest from $5K today at lifesherpainvest.com.au/invest and start climbing.
And we're back. So we're now going to move on to what's probably the more interesting part of investing, and certainly the bit that gets a lot more airtime and press column inches, that this is the engine of growth. So this is really important, but as I always say, if some is good, more isn't always better. And so getting the right allocation is important. So the first of the Bs is BRICS. And BRICS covers 2 classes of assets, real estate and infrastructure. They share a lot of stuff in common. They both generally involve land. They both generally involve construction on that land. And they generally have fairly stable cash flows. So looking at infrastructure first, infrastructure are all those things that keep a civilized modern society moving. These are things like electricity generation and distribution, pipelines, mostly gas pipelines, railways, not a big deal in Australia, but certainly in the US, railways are big, roads. Australia's been a great exporter of infrastructure funds management expertise, and Transurban, the owner of many of the toll roads in Sydney and Melbourne, is a significant part of the global infrastructure index. Utilities, so gas and water, telecoms, mostly cell phone towers, and cable networks, airports, of course, and ports. And these are, I guess, the modern equivalent of the utility stocks. So if you've ever played Monopoly, you'll know that the railways and the utilities, the gas company, the water company, the power company, they all lead to very stable returns. They're generally operating monopoly businesses. They're generally heavily regulated by governments, and there's generally very high levels of barriers to entry. So all of those lead us to a equity-like return, but with a lot more stability. You might have heard your parents talk about investing in the phone company. So Telstra was always a important part of a conservative portfolio. That may not be true anymore with the way technology is overtaking telecoms, but generally infrastructure forms a very solid part of lowering your overall risk without giving up much by way of returns. Real estate is sort of similar. So real estate is generally companies or trusts that own property. In the core sense, they're holding that for rental purposes. So they're shopping malls, so Westfield, Centre, there's lots of global players. Unibail, for example. So they own retail, so shopping malls. They own factories and warehouses. That's called industrial property. They own increasingly healthcare, so hospitals and clinics. To a lesser extent, residential. In the US, the major fund managers are now starting to be significant owners of certainly multifamily dwellings, maybe not so much individual houses, but certainly multifamily dwellings. Increasingly, it means data centers, which is the core of the AI business. It also includes self-storage. So we modern people spend all of our income buying stuff and then spend money storing it. And of course, offices and hotels. Generally, the properties are on very long-term leases to high-quality tenants. So think about an office building lease to the government or a warehouse lease to Woolworths, long, stable cash flows. In an Australian context, the Bunnings warehouse portfolio has long been a staple of stable, high-yield returns. Do be careful, though. An Australian real estate investment trust, or REIT, is often how it's abbreviated, are different. Most Australian players in this space do property development as well. So think about the Goodman Group, Mirvac, Dexus, or Stockland. All of those businesses have very significant property development pipelines, which is a much higher risk, higher return business. And so you will find that if you look at a portfolio of Australian real estate businesses, the Vanguard Australian Property Fund, or VAP, as an example, and compare that to a global fund like DJRE, for example, you'll find that the Australian one should outperform. It should give you a higher return because you're taking higher risk. Now, that's not a particular reason to prefer one over the other. They are different risk profiles. Now, both of these BRICS entities, real estate and infrastructure, they're there in your portfolio to provide a bit of ballast, provide some stability without giving up much by the way of returns. And generally, this has worked well historically. It didn't work particularly well in the COVID downturn because, of course, we all stopped shopping. We stopped flying. Airports were largely closed. Airlines grounded their fleets. We weren't going out shopping. We weren't staying in hotels. Some hotels did well from housing quarantine facilities, but generally both property and infrastructure fell during the COVID downturn, along with equities generally. But when you look at most other downturns, you look at 2022, you look at the GFC, you look at 2000, you look at 87, you look at 82, the real estate portion acted as a brake on the downturn in your portfolio. So these things work in most cases, and you're really looking for that balance, a probability approach, but it doesn't always work. Infrastructure has bounced back quite strongly, although we have seen some of the unlisted assets being written down in our bigger funds in the recent past. Real estate's much more slow to come back. It's been buoyed by the growth in data centers, but it's been a bit of a struggle. So much of that recovery hasn't really happened. Transactions are starting to happen in the physical market, so we're starting to see valuations stabilize. I think we'll start seeing some increases very shortly. But that's the fourth B, BRICS. And then the final B is businesses. You might know that as equities, shares, or stocks. And essentially, when we talk about businesses, we're talking about portions of the great companies of the world. And this is often where people turn to first when they think about investing. We look at Australian shares, which is usually referred to as the ASX 200 or the ASX 300. That's the 200 largest or the 300 largest shares companies in Australia, and the S&P 500, the Standard & Poor's 500, the 500 largest companies in the US market, and of course the NASDAQ. All three of those dominate the holdings of beginner investors. And that's appropriate. And we see that in practice. The Vanguard Australian Share Fund is the biggest ETF listed in Australia. It's got $22.5 billion under management, which is roughly the same size as the 24th largest company in Australia, which today, as we record, is WiseTech Global. And when you look at the holdings on Pearler, one of our more popular share broking sites, the Vanguard Australian Share Fund, an ASX 300 fund, and VGS, the Vanguard Global Share Fund, which is a World ex-Australia fund. About more than a quarter of Pearler investors hold both of those. And that's usually where people start. And it's a good place to start. It's a good way of learning. It's relatively cheap to get into. It's very liquid and a great way to learn about investing. But not all companies are created equal. And this is the key to investing, and part of the reason why stock picking, that is trying to choose individual shares, can be pretty hard to do successfully. So when we look at the US, where we got the best data, there's been 30,000 companies listed in the USA over the years. There's a database of all of these called a CRSP, or CRISP. That's the Center for Research in Security Prices at the University of Chicago. They maintain a database of all of these funds. You can go on their website and download it as a spreadsheet. And what that tells us is that over half, so 15,015 of the companies in the database, have delivered a negative return over their lives on the listed market. That means all the time they were listed on the market in the US, they lost money for their investors. Some investors may have made money, but if you held them from the date of listing to the date of delisting, you'd have lost money. And so that's a 50-50 shot. So if you flipped a coin, you're more likely to pick a loser than a winner. The winners, on the other hand, are far more concentrated. So just 2.5%, the top performing 2.4% of all of those listings account for all of the $75 trillion in net wealth created between 1990 and 2020. So that's about a 1 in 40 chance of picking one of the winners. And that's pretty tough. Outside the US, it's even worse, which is 1.4% of all firms accounting for the $30 trillion in net wealth created. So what are the odds of you picking the 2.4% or the 1.4%? And that's why diversification, broad-based equity funds are critical to investing. Picking individual stocks is a tough game. And you might say, well, surely there's some way of identifying the likely winners. And there's a huge amount of research that has gone into trying to work out what makes a winning company. And Eugene Farmer and Ken French, Farmer and French, also from the University of Chicago, are probably the key names in all of these, along with a guy called Carhart. So Farmer and French produced a paper where they identified 3 key factors that determine whether a company makes money or not. So the first factor is what the market does generally. It's called the market risk premium. So generally, shares deliver higher returns than cash or bonds. They don't always, but over time you would expect to be rewarded for the risk of investing in a company. And over most time periods, that's true. It wasn't true for the 40-year period from 1969 to 2009, and it wasn't true for much of the 19th century. But over time, you would expect to earn a reward for the risk of investing in a share compared to a bond. And that certainly proved to be fairly resilient over most long periods of time. The second factor is size. So generally, smaller companies outperform bigger companies. And that shouldn't be too surprising. If you think about if you're a manager of a company that's got $1 million of annual sales, it's much easier to double it than it is to double a company that has got 10 million or 10 billion of sales. They're also riskier, and so you should be rewarded for that. So for generally, small companies outperform big companies. The third factor that Farmer and French identified, what's called the value factor. This is a little bit more technical, but broadly it says that companies that trade on a high multiple of their book value, so the value of their assets in their accounts, this is called a price to book ratio. You can also look at this in terms of price to earnings, so what multiple of the annual profit are you paying? And unsurprisingly, given that companies are effectively worth the present value of all their future cash flows, the bigger a multiple of that cash flow that you pay, the lower return you should expect to make over time. And so value companies tend to trade on low multiples, so they're generally more stable, more established companies. So think Australian banks, Australian miners, contrasted with growth companies, which you're paying a high multiple of today's earnings because the market expects those earnings to grow strongly over time. That's what they call growth companies. So in that context, you can think of Facebook, Google, Apple. These are companies that are experiencing high growth, and people are prepared to pay a very high multiple of today's price for that. And that all works well until the rate of growth slows. And that's why value companies tend to outperform growth companies over time. It's not always true. And clearly over the last few years, with the domination of what are called the Magnificent Seven, Facebook, Apple, Google, Nvidia, Amazon, they have been delivering most of the returns in the US. That's in contrast to Australia, where much of our returns have come from the banks. So most high-profile investors would consider themselves to be value investors. So Warren Buffett would consider himself a value investor. So he's looking to buy companies that are deep in that value space. You're paying a very low multiple for today's earnings, and you hope for those earnings to grow and that premium to disappear. So that's value. So when you look at many of the bigger active fund managers, you'll find many of them fall into the value sector. And of course, if you put those two together and you get small cap value, that's a very attractive sector to be in. At LifeSherpa, we invest a significant chunk of our equity allocation to small companies. That's companies outside of that top 300. And that's an area where a good manager can add a lot of value. They were the three original ones. There've been there've been thousands of these factors identified, but there's really only 5 that have been persistent and broad-based. Farmer and French then came back with a 5-factor model, having worked out that there was more to it than the original paper, and they identified 2 more. So they said that, and this should come as no surprise, that profitable companies outperform unprofitable companies. And so that's a company that's where you're seeing high profits per unit of sale or per the price you're paying for it. And the 5th one that they adventured was investment stocks. So stocks that spend a lot of money, they have a high level of capital expenditure, or they're spending lots of money doing takeovers, they tend to underperform companies that have a low level of investment. The other one that, okay, the sixth factor has historically been really hard to implement because of the cost of trading. The cost of trading has been falling very strongly over the last 2 decades. And so this factor called momentum, that is companies that are moving up in price tend to continue to move up. So and a momentum investor is looking to identify companies that are moving up in price on strong volume. This is in effect buy high, sell higher. And it's a bet on the tendency of stocks with strong recent performance to continue performing well, and those with poor performance to continue doing so. This factor has been supported by academic evidence for decades, but it's been pretty hard to implement. But now we're seeing the cost of trading making it this possible. It used to be too expensive, but falling trades have now made that possible. So they're the 6 factors. So taking those into account, we can then look at companies in a broader sense. So pulling that back together again, we have 5 Bs, 3 defensive Bs, bills, bonds, bullion, and we have 2 growth Bs, that is bricks, infrastructure and real estate, and businesses, shares. And any portfolio needs to be put together on those 5 building blocks. There's 2 more Bs. And how you put those together is what drives both your return and your volatility. And we'll look in a future episode about how we put those together once we've gone through understanding risk. So next time we're going to focus on risk. We'll come back to that in a future episode. So today, that's the 5 Bs. Every portfolio will be built up from those building blocks. So from me, Vince Scully, this is Investing, and I'll see you next time.
Thank you for listening to This is Investing. Any advice is general financial advice and does not consider your objectives, financial situation, or needs. You should consider whether the advice is appropriate for you before acting. Always read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs before buying any financial product. Vince Scully is a representative, and Simo Interactive, Pty Ltd, and Glenn James are authorised representatives of Money Sherpa Proprietary Limited, which holds Financial Services Licence 451289. Thank you for watching, and remember, if you want to get more out of your investing, The Quick Start Guide to Investing, it's a book that we've written all around investing. You can have a look at this. There's a link in the show notes. Thank you for your support. And if you want further investing fun, The Quick Start Guide to Investing, as endorsed by Vince, obviously, is available wherever good books are sold, or there's a link in the show notes to get your copy today.